Hey YouTube, it's Dimitri. Today we're going to go over the power of retail credit. So this is a presentation I did for the Illinois Tech Conference, so the Princeton Illinois Tech Conference. Princeton's in the spring, Illinois Tech was in the fall here in 2024. Subscriber asked if I would do a video just kind of going over it. I will try to hurry through it. When I present these are like 45 minutes to an hour, but there is a lot of interesting detail and pieces here in the quant space. I think most students and industry practitioners just will never see because you just don't work in this space. There's a lot of discussion and hype and excitement about investing and buy side and derivative pricing. But today we're going to kind of dive into here on the retail credit side. We're going to look at market size. We're going to look at sell side, which is the banks a bit more, and kind of show what we do, like how we model things a little more. Again, this isn't a modeling presentation, but it will show you kind of what retail credit looks like and all the different flavors from a very, very high, fast pieces. I could spend probably years talking about this. All right, so to start off with here, I think it's important to start looking at markets and market size. The U.S. equity market is $55.2 trillion in 2023. Mortgage originations are going to be $1.5 trillion. So thinking about when we start talking about credit products, you have originations and you have balances here. So every year you originate new loans, and every year loans either charge off, they go bad and someone doesn't pay you back, or a loan completes. And when that happens, you have essentially loans falling off the books, and then you have new originations every year, right? Somebody buys another house or another car or credit card here. So we'll talk about that a little bit. But outstanding real estate, so this is going to be the consumer real estate. There's an entire marketplace of commercial real estate. You think about skyscrapers, warehouses, strip malls. That's all on the commercial side of it. It's not even included in this discussion here, but banks do that as well. But of course, with the consumer real estate market, it's about $47.5 trillion in 2024 here in the United States, right? This is just US markets. Auto originations is $739.4 billion as of March year to date 2024. And credit card debt was $1.14 trillion as of Q2 of 2024 there. So that's just a balance in time, how much credit card debt is currently just outstanding. On the right here too, you see the market size, giving you kind of some bar charts, some understanding of these numbers. Looking at equities, right? Everyone's talking about trading equity and stocks, which is equity. And then people talk a little bit about fixed income. And then I'm just putting mortgage on here as a product so you guys can kind of see the magnitude of this. And also realize a big portion of that fixed income is actually mortgage products. So we'll get into here in a little bit, but you securitize products and you resell them to markets. That's fixed income products. Mortgage-backed securities falls in those fixed income numbers. Mortgage-backed securities are just mortgages that have been packaged and sold off to investors. You have other asset-backed securities, ABSs, you have bonds, you have money markets, and other sorts of products that will kind of bake into the fixed income space here. I have on the bottom too, living versus fixed in life. So understanding these, we're going to talk about revolving credit lines, which is kind of like a living product. Credit cards, for example, are revolving credit lines. They're alive. You can go spend and borrow money, and then you can pay some money back, and then you can borrow some more money, and then you can spend money back. And you always have that limit on there. And that limit gives you some sort of container, but you empty it out and you can refill it essentially as you use it. It's a living product. Fixed life is what I'm talking about here. Is going to be things that are going to be like installment contracts, which I'll talk about here in a second. But essentially, like you make a loan for a car, a house, a personal loan, some other sort of product. It has a schedule of payments, could be a bond, for example, as well. It has scheduled payments, and then you're going to just make those payments on specific dates here. It has a fixed life. You do that for X amount of years or months, and it's completed here. Mortgage markets in themselves, I think, are just interesting because I don't think a lot of quants think about this, except for like when you watch the movies on mortgage-backed securities, and then it kind of fades out of your mind, like, oh, it's this boring side of credit. But starting to understand what are the different marketplaces here. So I work at a company called Agora Data. I've been there for, 2.5 years now. It's been a fun, exciting journey. Before that, I worked at Santander. Again, big global bank here. I worked at technically SBNA, which is Santander Bank North America, or Santander Bank holding company. Like I worked at the big parent company, and then there's a subsidiary of Santander called Santander Consumer SC. They worked in subprime auto as well. So Agora and Santander were doing subprime auto lending. You can see here on this left-hand chart, super prime, the green is like the people that are making pretty good money in the US. And then you have prime, which is like, still pretty good. And then you have near prime, which is like, you're probably a working, a real tough kind of gig, but you're probably still hanging in there. But it's tight. Like financials are tight there. And then you have subprime, which is going to be where I have worked. Subprime and near prime. So the yellow and the blue on this chart is really where a lot of my career has sat. The majority of my years has been in these markets. Now, it's not to say anything good or bad about these sorts of markets here. It's just, it's different players, different consumers, different sorts of models. So models will be the same, but there are very different drivers behind these sorts of pieces here. And then also what's more interesting is consumers actually rotate through these groups. So, as our CEO always likes to say, everybody is born prime. Yeah, you are born prime per se, and then things happen in life. You make bad financial decisions, an emergency happens, something kicks in, your parent gets cancer or something, and you're trying to cover bills with them and help them out. Life's tough, right? It's not going to be easy. You will probably cycle through all this. I was fairly subprime at some point, maybe near prime, I don't know. Poor college student, married, at 20, wife is 19, trying to make bills, trying to make ends meet, making a few bucks an hour here, living paycheck to paycheck and taking out massive loans to finance my schooling as well as my cost of living here. So I get it. It's a tough, interesting market here. Finances and financial markets are quite intriguing, especially when you've kind of been on both sides. But if you look at the right-hand side here, and ignoring the originations here on the left, you have balances. Balances are going to be 47.5 trillion, as we mentioned, with total values of homes in the U.S. The national debt is 33.9 trillion. So that gap is actually going to be the difference between what is actually the valuations at and how much debt is outstanding on those mortgages. That gap really is not that big. Like there's a lot of debt outstanding on these balances, which is pretty shocking, or it should be to many of you. Most people do not own their home. They are just making essentially payments on these installment contracts, which is a mortgage here. To look at other debt markets as well, you start to look at student loans. Student loans are not nearly as large as everybody makes them out to be. Everyone's like, oh, it's this huge burden. You can see here, you stack these charts here back in 2004. The red part is going to be student loans. It was tiny compared to the other ones. It's more than others, but it was significantly smaller than credit cards and auto loans. Even when we fast forward to 2024, it's about the same size as an auto loan. So yes, it's a big burden to take on a student loan. I won't get into this tangent here on if you should be getting into debt or not. But I would argue most people taking student loans these days probably just aren't thinking ahead on like what you're using it for. An auto loan in this case is probably much more valuable because, you need a car. It's a pretty easy case to do that. Now, the credit card debt could probably get away, and the other as well. But again, this is all the other non-housing debt put together here. And you can see here that it's a pretty good chunk. It's a big, interesting piece here, right? But there's a lot of debt out there and a lot of debt products that have to get sold and securitized. And somebody owns that. Someone's collecting payments for that. So there's an entire market around this as well. To get into size here, I think a lot of people, especially people on Reddit, for example, and on the internet, these young individuals, everyone's really excited to get into, so there's sell side and buy side. Sell side is going to be banks. Buy side is going to be investment funds, for example. But more specifically here, everyone gets into like the trading side of it, right? I want to be a trader. I want to make a lot of money. These hedge funds are, they're huge. They're billionaires, whatever. And they're going on about it. Often you don't realize the magnitude of the size of the firms. And not to say this does not represent compensation, but I think it's interesting to look at the difference in size here and assets here, because this was something that surprised me. The banks here on the left, so you look at the largest bank in the world is going to be the Bank of China. It's a huge bank here. I think it's in $6 trillion, it looks like. And then your JP Morgan Chase, which I just threw in there, is kind of another big known bank here. Not necessarily the second largest, I don't believe. I think China has a few different ones. I can't remember if I added them all together in this chart. But you have JP Morgan Chase, a little under 4 trillion there. You have Bank of America coming in a little more than 3. On the far right side, you have wealth management. So these are not the, the prop funds that are trading their own money. This is not going to be the firms that are doing market making here. So you can look at like Two Sigmas and Citadel in here. like Renaissance Technology and Bridgewater. Again, hedge funds, things that are very specialized, smaller firms. But you look at the wealth management side of this, BlackRock is enormous. This is why everyone talks about like how crazy BlackRock is, because the size of BlackRock it's truly enormous. It's just in a huge firm. And then you got Vanguard and you got UBS here. So you can kind of see, looking at these different firms and sizes. And then when you start to look again at the hedge funds, they're tiny on this sheet. They're a drop in the bucket. Now, you have to understand markets here, right? I'm not trying to say one's good and one's bad. These firms are much smaller. They're much more nimble. Again, they're doing market making. So they always tout the numbers of dollars they rotate, but they don't have a lot of dollars per se in comparison to a bank or a wealth management fund. Now, that being said, the number of employees it takes to run like a bank or a wealth management fund is huge. I've worked at a few firms with more than 10,000 employees. And so you think about the entire staff that it takes to run one of these enormous firms, right? It takes, tellers, it takes financial advisors, it takes, all these people that manage and maintain buildings. It takes people that do quants, that build models. It takes accounting. There's whole groups of people that specialize in different products and services and sales and marketing. And they're enormous firms. Now, again, for a lot of quants, it's exciting and fun to get these, hedge funds, for example, because it's really specialized onto doing just what quant finance. Like you start to really narrow in here. You don't have the breadth of these other firms, but it's actually exciting in that stance because you can really focus on what you want to do here. Now, the banks are big and stable. You will not see as much fluctuation in layoffs and hiring and salaries. It's fairly constant. That's another trade-off here within these different funds and firms here. Trying to think about this, more broadly, there's a big difference, again, between banks, wealth management, and more or less like hedge fund and HFT firms here. Now, diving into subprime auto markets, because this is right where I've been working at. Loans are viewed typically what we call a vintage. So a vintage is a month, a quarter, a year. It's some sort of snapshot in time, a little window, and you look at everything that was originated in that period, and then you check performance of that vintage, that snapshot across time here. This is the December 2023 vintage here, or the entire market here with auto. You can see the originations year to date as of that month was going to be 25.3 million. The loan amount year to date, so that's going to be the actual balance sitting there, is 739.4 billion. Percentage of subprime auto originations was 15.3 here. So again, this is originations. This is not balances, right? When we went back and looked at some of these auto loans, they're in the trillions. But when you look at originations themselves, even the originations are going to be in the billions here. So pretty large. Interestingly enough, when you start to get these sorts of reports, this one comes from Equifax, you can start to nail down, there's different types of firms that do different things here. So the banks, you can see in this bottom left-hand chart, is 6.9 million in originations. It has captive firms, credit unions, dealer finance, and all that. You can kind of see the origination year over year. There's interesting trends and shifts in who is taking market share. So you look at like Carvana and you look at some of these, CarMax, there's other online auto retailers that are taking that market share. Credit unions, again, are very, very safe. So credit unions in themselves, again, are probably losing market share. They do not have the technology. They don't have the models. They don't have quantitative finance to guide them. This is a lot of what Agora Data actually does. We build technology and we provide the capital as well, like a bank, to the auto dealers and also, other firms. So we focus on the auto dealers, the finance companies as well. And you can actually get funds and technology and compete with the big boys, who's going to be like the banks and the captives. But to do that, right, you're not going to go out and hire quants at, starting salaries of 80, 70, 80, and then have quants going through a few $100,000 plus bonuses, everything else. And then you got to manage a team and have a structure. It is very expensive to have models, but it is very, very hard to compete when you start to compete with kind of the banks and the captives here. Now, again, you look at origination distributions by score bands. Again, we talked a little bit about this and saw the charts earlier. Deep subprime, there's auto, loan, and lease here. So leases are a little bit different, but right, deep subprime's not a lot, and then subprime, and then near prime, prime, and super prime here. An interesting note I would just like to put on this is understanding different banks actually specialize in different bands of the credit range. So when you look at big banks like Chase, for example, and Bank of America, I believe, they're specialized in prime and super prime, right? The modeling is easier. Let's say you have a 3% bad rate, right? 3% of loans go bad. Like, I mean, you have to use a scalpel, and it's a very competitive market, so don't get me wrong. But it's hard to lose money in a lot of these spaces when you're super prime, for example, unless a financial crisis hits, because a lot of these super prime consumers are actually way overburdened with debt. And then when the markets turn and a crash hits, they're going to end up subprime and your defaults will spike through the roof and whole other thing. But then you look at other firms, for example, like Ally, Santander used to do it more. They've gotten out of it. Capital One, they're going to be deeper subprime. They're going to be subprime probably for the most part. Not a lot of banks want to touch deep subprime, so you start to end up having to go to sketchier finance companies, smaller dealerships. There's something called buy here, pay here, which is an interesting concept. You buy a car at a dealership and you make your payments to that dealership. Often that dealer is actually financing your loan. There's not a bank. So again, they're sketchier, deeper subprime. They're running out of options for credit here. But there are different banks, different companies, different institutions that specialize in different kind of slivers of this market share, and everybody's competing, but everyone likes to specialize in one area. I can tell you on the model development side, it is different. The problems are different, because we mentioned like super prime might have a 3 to 5% bad rate, for example. When you drop down into like deep subprime, you could see, 60, 70, 80% bad rates. So 80% of every loan you buy is charging off. Now, I know some people are going to say, well, that's not really common. And well, it depends how deep you're going. It depends what markets you're in. It depends what demographic, like geographic location you're in, for example. So there's different pockets and areas. But anyways, it's really interesting space to be in. And you can really see there's a huge difference in credit quality. And the modeling problems are very challenging because you can end up with a very imbalanced population when you do the modeling, and it can make it really easy or really hard depending on kind of how your data is structured and how the market moves. So market movements is something that's hard to capture and get into these models. But there are many interesting problems in credit. So I don't have all the problems listed on here, but I listed some common models so you guys can kind of get an idea for this. There's different types of credits. I mentioned revolving, which is going to be like HELOC, home equity line of credit, and credit cards, right? It's a balance you have. You can borrow up to that much and you can pay it back and all that. Installment's going to be, like I mentioned, those loans that you just make set a number of payments, which is commonly auto, mortgage, and personal loans. The modeling is all going to be different between these two as well. I worked with global credit card portfolios at one of the large global banks, for example. So that was revolving credit lines, a little bit different modeling issue and challenges there. And then when you get into installments are a little bit more straightforward. I think there's a lot more literature on that as well. It just depends where you end up in a career. You might end up on one side and then you just figure it out and do that your whole career. But I've worked across both spectrums with this. Common models, though, for example, are going to be probability of default, loss given default, and exposure of default. If you take a traditional finance class and they teach CECL approach, which is the current expected credit loss, so that's CL approach to doing this, which is a regulatory requirement for everybody. I think it goes from large banks down to credit unions, and depending on your complexity, using the CECL approach in multiplying PD, LGD, and EAD is required. You're going to be taught in finance school, EL, expected loss is equal to PD times LGD times EAD. That's fine. That's an equation, right? Someone just wrote it on a piece of paper. It doesn't mean anything though, because there's actual statistical models. Each one of those can be a statistical model or an assumption, and then you multiply all them together to get your expected loss for that loan. You have to predict those losses at the beginning of the loan. There's also return on assets, so ROAs. ROA models do things like yield, like what percentage return am I going to get for making this sort of investment? That's what investors are going to want to know. Firms and banks are going to want to know it's profit and loss, kind of the same thing, right? What's the dollar value we're going to get back on this? There are models for that. Roll rate models are something else that are quite common. So when you have a consumer that rolls delinquent, so 0 to 30, they're making all their payments. And if a customer misses their monthly payment, they're more than 30 days past due. So that's called 30 to 60 in there. There's 30 to 59. And then you have, 60 and up, and then you have 90 plus. And then if you typically hit 120, 120 days past due is typically considered what we just say charge off, like the loan just charged off. But there's a roll rate because a specific portion of the population of your loans will roll between those categories. So consumers might be struggling, especially in subprime, and they might commonly roll to like 50 days, 52 days, right? They miss the payment at 30. They're trying to borrow some money. Maybe they got a side hustle. They're getting some cash in the door. And they're a few weeks behind, but not quite that second month. And then they roll back to current, like they're within their range. Or maybe they roll worse into that, 60 to 90 bucket there. So now they're, a few months behind. We're starting to really look like we're stressed. There's models that model which consumers specifically will roll to which buckets here. And I will note, all this modeling and pricing stuff is done loan level. So we're looking at an individual consumer who walks in the door, and I'll show you some variables here. And we actually look at all the attributes, and it's a model or two. There's some models and other things, and it will price out these sorts of loans. And you can kind of see like, okay, this consumer should perform like this given the data we have and the modeling we've done. Anyways, other model is going to be lease values. So worked on a model at one of the banks where essentially when a vehicle was leased out, the bank would have, the consumer would have the option to actually buy the car from the bank at the end for a set price, or that vehicle could go back to the bank and then the bank would have to sell it to auction. When that happens, there's a residual value to this, so a lease value that comes back. So the bank owns the car, they make the lease, they collect the payments, and then the car comes back and then it has to go to auction. And so we need to figure out how much cash we're going to get back for that vehicle at auction. There's supply and demand. There's economics based into this on vehicles and different types and market trends, everything that impact this. And then there's, just how does the consumer treat the vehicle? Like, did they trash the car? Do they treat it like a baby? Do they have some sort of servicing package purchased with the vehicle? All these sorts of things impact residual value or the lease value here when it comes back. Whole other interesting thing, in 2021, I believe, if I remember that's what it was, used car prices were through the roof. We purchased cars that were on lease. When they were coming back, we were getting more for the car at auction than the car when we bought the car originally, because used car values were so crazy during COVID here. So it's an interesting, weird time and a whole modeling and perspective to look at these sorts of things, but a very interesting time there. There's fraud models, right? There's dealer fraud and there's consumer fraud. You start to look through this and you have to model these sorts of things out. Securitization and tiering. So I'm working on a securitization right now. Again, how do you tier these loans? How do you score them out and create buckets and bins when they go to market? A firm can say these are different grades of installment contracts, and how much do we expect to see in losses, which is CNL, so cumulative net loss. I know some people call them NCLs, which is net cumulative loss or whatever. But anyways, securitization, tiering, there are models behind that. There's repo timing models and call timing models. These are all what I would call behavior models. Yes, we look at how many times should a bank call a consumer and when should they call them to get optimal collections for a vehicle that is behind on payment, right? There are laws actually in place on how frequently you can and can't call. However, do you call their work number? Do you call their personal number? A cell phone, is there a home number? Do you call them, once a week, once a month? Like, what do you do in that process? These are behavioral models. Same thing for repos. You can assign repossession of a vehicle. Car payments weren't made. Car went to charge off. You need to go pick the vehicle up. How do you repo the vehicle? Who do you assign first, second, third, fourth to optimize the timing of repossession? Because the faster you can get cash back on the book for the business, the better the business looks. You also save money because now you're not spending a ton of time collecting loans that you just know you're not going to collect there. So again, whole assortment of models there, just to give you a few ideas of some of the types of models you could see in a credit career. Probably no default. I'm just going to throw this out there as an example. This is a very common model here, right? This is kind of the risk of the loan. What is the probability you will default? First off, what is default, right? How do you define that? This is something I don't think a lot of people think about. There's not like a magical column in a table that says default, like the consumer defaulted on it. You have to define that, and there are going to be limitations around this. So you can define these here as 3 examples. One is, the last one's going to be charge off, right? The loan charged off, it actually defaulted. Now you have to wait. So when you originate loans, you have to wait for all of that data to complete through the contract date to get an actual value to get to charge off, right? So you originate, let's say loans, auto loans say 5 years or up to 7 years, you got to wait that whole cycle for that vintage to actually complete before you can get a complete sample and understand what happened to the data. Now, if you wait like a year or two, it's going to be biased because now you're not going to see that full amount. So using charge off probably isn't the best indicator. We want to know the results quicker. And one way to do this is shorten that window that we're going to use here. And we're going to assume there's a different definition of default. Here's 2 examples. Like ever 60 days past due within 24 months. You could do 12 months. You do 18 months, 36 months, up to you. Or you could do ever 90 days past due. So you could adjust, the days past due here. But this will allow you to see like, okay, we're going to consider, we're going to call bad. I'm going to call it bad in air quotes here. It's a bad loan because it did not perform. And the performance indicator we're going to use is, let's say, ever 90 days past due within a 24-month window. Now, when I originate loans, I only have to wait 2 years to see if they were quote unquote bad instead of having to wait a lifetime for all those loans in that, actual vintage to complete there. Interestingly enough, though, right, it's either good or bad. It's binary. There's only 2 categories I'm kind of showing you guys here in the bottom left-hand chart with the bar chart. And when you start to plot these with the independent variables here, right, those predictive characteristics, the top right chart, again, is completely made up, fake data. I just threw on here income, right? You see the income ranges here, and it's going to either take 2 values, 0 or 1. So they're spread out on the top and on the bottom. There's no way around this. This is how the problem is set up that we're trying to model here, which can be a little bit challenging. A kind of a tricky little thing I'm going to show you guys here with this is on the bottom, I made up another set of data on trade lines. And let's say this is only integers, right? You can only have 1, 2, 3, 4, 5, all the way up to 12 in this example trade lines. You can't have a half or quarter trade line. So again, this is simulated data. Both these charts have 1 million observations in them. You will notice the chart on the bottom does not look like it's 1 million because all the data points are stacked. So you don't see that. So using a chart like this is a bad idea when you go into the model development side. So trying to show you guys the perspectives. We often start to shift into histograms because you can kind of see, again here, this histogram, the most of them sit at, about 6 trade lines here. And you cannot tell that on the right-hand side here. So there's going to be little nuances and tricks and issues you're going to face here as you get into the data and the modeling side of this. And it gets exciting and fun. And we'll keep going on here to look at what does data look like and some of the challenges with it. In this example, I mentioned there's over 1,500 variables from a bureau. I think right now I have over 2,200 variables right now that we're using internally. So you have to kind of sort and process and work through all these. It is hard. There's a lot. You have a big data problem. So machine learning can be your best friend in this case because you have so much data. That being said, you also have to explain often to consumers why they got scored the way they got scored for a loan, or if it's an origination model, there's models for originations. If you decide to originate a model and price them, you have to explain to a consumer why. Why did you get turned down for that loan? Why did you get a specific APR? So these are challenging things that you will find in the credit space. The other issue here, I don't think a lot of people really realize is this is consumer data. We are not the tech industry either. We're not just pulling people's data because I can, right? We're not just going out there stripping people's data from the internet. Banking is very strictly regulated, which I think is a really good thing in many cases. Sometimes we're overregulated, but most of the part, it's got good intentions and some bad implementation of it. But getting consumer data, getting bureau data, you can go to a bureau agency. You can't just waltz out there and purchase it. You have to have a reason. You have to have like a justification and a cause for doing that. And I know this because I've had to work with the bureaus when you go to get data from them, right? You could say, hey, I've got, $1 million. Can I buy some data? If you don't have an actual use case for that and you don't have a justification like they are your customers, they're not really going to want to work with you. And we've been turned down. I've had companies turn me down at other companies I've been at for data. Like, we're just not going to sell you the data. So it's very different than the buy side of this, where you can go to Bloomberg and you just purchase data, right? Shout out to Quant Connect and Data Bento, right? You can just go out and buy data from them. You can't really do this with the bureau side. Like, not everybody can get into this marketplace because data has all these regulatory restrictions around them. And I've had issues with this. Like, it was just like, I just need this data, right? And it's like, well, you don't own this customer's data, and so you can't get access to this, and there's requirements and restrictions and all that. The bureaus are great. They handle a lot of this. And then, of course, you have lawyers internally that help you kind of navigate. But There's also the possibility you can buy blind samples. So even when you get data, if you have customers, sometimes you can buy a sample to append to your, the data you currently have. They blend all of it together and they hide it so that you cannot figure out which customers are your customers, which customers are the samples customers. Again, there are privacy concerns. There's a bunch of issues with this, what makes it challenging. Also, cleaning bureau data is hard. One of the unique pieces here, a lot of people don't realize, is with bureau data, there are many types of missing values here. So I'll give you an example here. Let's say there's no trade of this type. So we're looking for a mortgage and you don't have a mortgage, right? It's going to come back missing. It's not verified in the time period. So maybe they have record that you have a mortgage today, but if at the time that they pulled this, say you're doing a historic pull or something, if you don't have a mortgage, they can't verify it. It might not be that you don't have one. They just don't know that you don't have one because they can't verify that for some reason. Maybe you're in another state or I don't know, some other sort of issue. No open trades of this type. No trades on file. Cannot calculate the variable if it's calculated. No trades opened for required time. So if you're using a snapshot window, like a 24-month period. No detected event and no items of this type. They can be a little archaic, like a little, challenging to interpret sometimes, but you'll read the definitions and you have to reach out to the companies. There are many, many types of missing, and how you go about handling these missings can make a huge difference here. So you cannot just fill them. You also cannot just put zeros in. So something else is like, let's say, it's a mortgage balance and it's missing. Well, it's missing because you don't have a mortgage. Well, you can't just put zero in because that's now a number. Now, if you go to build a model or you go to take an average or do something like that and there's zeros in there, you're going to end up with bad data and bad conclusions with that. So there's a lot of interesting pieces here, and I'm going to show you guys here in a second how I handle that in most cases. Again, examples of variables, percentage of accounts ever delinquent, months since most recent delinquency, number of distinct home phones within the last 24 months, number of third-party collections opened in past 36 months. These variables are very specific. The bureaus know a lot of data about all of you. And we use this to build models. But again, it's financial data. We are not going out and stripping ridiculous information like social media information or any of that. There are regulations against that. I also don't think it is actually morally or ethically correct to do so, which is a whole other conversation I've mentioned in other videos. But it is nice to get into these nitty-gritty details on financial data to figure out like, okay, a consumer has defaulted or hasn't defaulted. Now, I don't make a judgment call. We use statistics. We put it together. We meet with the business. We think about it from a conceptual soundness perspective. Does this actually make sense? I don't want just correlations here. And we go through and we do the whole model development process. The other piece of this is now starting to think about the dimensionality of this, right? A lot of people get really excited. They throw data in, model comes out, they're really excited. But you need to start thinking through how things work together. There can be all kinds of issues you can have in a model here. And then when you're highly regulated, you have to explain this. And also from a business stance, how is a business going to use your model if they can't explain it to a consumer? Or if you're selling your model as a service, for example, how do you explain that your model works besides like, it's really accurate? It's like, great. But how does it work? And how do I know you're not breaking laws if I purchase your model as a vendor, right? You're a vendor selling the model. There's all kinds of issues with this. Explainability is a really challenging part, but it's a really necessary part in many, many cases here. And as you start to get into these models, like logistic regression is a common model we use, for example, for PDs. I know a lot of banks have moved to like GBM or whatnot, but logistic regression is tried and true. If you're running a good starting point, it's a good place to start. You typically target to have 20 to 30 variables in the model. This chart here shows you an example of 2 variables, and everything is going to be in these rows, these bars, because remember, you can only have 0 or 1. So you have zeros on the bottom, 1 on the top in this cube example. But then you could have like income and trade lines, which I have plotted out here, and you end up with this 3-dimensional chart. Now imagine trying to understand a 20 to 30 dimension problem, right? Now people are gonna say, Dimitri, that's stupid. Why would you do that? Well, sometimes you have interaction effects between multiple variables, and sometimes you need to think about this from a more mathematical perspective than a simple model, how accurate am I perspective here. I will note, do not use complex charts like this, right? It's interesting to think about these. Sometimes you will plot interactions, for example, you'll do statistical tests. Statistical tests are your friend because they will help you conceptualize issues and problems more holistically. Like VIF is variance inflation factor. It's looking for multicollinearity in the model. Again, one variable could be highly correlated to another variable. A combination of variables in the model could be highly correlated to one other variable. So again, don't get fancy with charts. I'm telling you guys this because this is good advice. I hate when I see these complex charts with multiple planes, like 2 Y's, and it's awful. Anyways, but yes, it will get complex. It will get challenging. Do not get bogged down in trying to create fancy things to do it. Look for more cohesive, conceptually sound processes and research that has already been done. Do not reinvent the wheel with this. Weight of evidence is one of these things I was talking about with transformations here. So weight of evidence is going to be the natural log of the distribution of goods divided by the distribution of bads. It gives you a weight of evidence value here. There are 2 kind of examples down here. I'm just showing you guys just made up data again. You're going to have, for example, you're going to have like how many goods and bads. It's kind of like a ratio here. The way this is set up is when you have more bads than goods, you have a negative weight of evidence value here. And then those consumers are going to be more likely to default in the example of a probability default model. If you have more goods than bads, you should be positive on your weight of evidence value, and so it'll be above. One great thing with weight of evidence, though, is it captures special values, which are often just different types of missing categories here. The missing categories themselves, right? Those missing values can get handled. They will be assigned a number, and then they will go through whatever model you use. So if you're using logistic regression, using gradient boosting decision trees, random forest, they will have a value. You can always handle those missing cases here. It also helps in tech with the data processing to detect true missing. If something comes in that's actually missing, like a loan value scores out and it's missing, you have something wrong in the data somewhere, because an actual missing from your data sources that go into the model should have been coded with weight of evidence. The other piece here is we look for monotonic relationships. This is good for explaining things to the business here. So as these values increase, let's just say this chart here on the right is income, right? You'd assume as income increases, the probability of default should decrease, for example, right? Now, I don't know if this is directionally correct on here, but bear with me as I give this example. So we're making this up on the fly. You want to see, though, a trend of it increasing or decreasing. You want to see it monotonic, because it seems very odd if you said, oh, if someone makes over, I don't know, $80,000, they're really likely to default compared to someone that makes 60. Now you'd have to think this from a business perspective, and you really should if you're a model developer, of like, why is the direction of the relationship what it is? And if it is not monotonic when you do your weight of evidence binning, why? Why is it not like that? And there are always going to be exceptions to this. But it makes it easy to understand the model. It makes the business too, when they go to do analysis and reporting and they use the model, they will get very comfortable with it because everything seems to work. Like, as income goes up, probability of default goes down. As LTV, which is loan to value ratio, goes up, probability of default goes up because it's a higher risk loan here. Number of past defaults goes up. The probability of default also goes up, right? So you want some sort of directional relationship. It does not have to be linear, right? You can look at both these examples here. They're not linear, but they're monotonically increasing or monotonically decreasing, or they have some sort of trend with it. Special values can also break that. So in this bottom left-hand chart, right, special values be different types of missings, different scenarios, for example, that don't fall into those numerical categorizations. They can fall into their own categories and be modeled separately if required to do so. Model selection is quite interesting as well. So there's accuracy. We use AUC. AUC is area under the curve. I have other videos on that. I will link them above or below if you're more interested on that and the credit space. But AUC is the ability to separate goods and bads here. And you're going to be looking at different models and ranking them. You'll see this bottom left-hand chart is going to be the actual chart, the area under that curve. So between the green line and these colored curves here, those are going to give you some sort of value, right? You calculate that out here. The green line is a 45-degree angle. It means you have a random guess, 50% shot. Credit space, specifically in the subprime space, anything between 70 and 80, so 0.7 and 0.8 on the AUC values is considered usually a good model. Anything less than 0.7 is usually something's wrong with it. It's not great. You have a serious issue here. Anything greater than 0.8 is typically overfit. So just to give you a relative range here. Now, when you move into prime or super prime, those values are probably going to be higher because it's much easier to build a model to separate out the goods and the bads. Other charts we look at, for example, are going to be bad rates. So again, you want a monotonic curve here. Now, companies build scores. So FICO, you think about FICO score, you could imagine this x-axis on this bottom right-hand chart is a FICO score. Again, this would not make sense because the bad rate is low for low scores, right? FICO is the opposite. So a low FICO score is high risk. So it should be going the other direction. But when you use PD to create these sorts of charts here, or you use some other sort of modeling metric, you're going to have some sort of chart that looks like this. You're going to see that there are going to be rankings, right? And you're going to see these dots that go up, and you're going to have bad rates with this. Now, also when you have scores, there's points to double the odds, which is a whole other thing. But more or less, you have to think about this now from a strategic perspective as well, of how much volume is going to be in each bin. You can use these sorts of charts to set strategy and to cut them. Again, I will put links above and below to other videos. In the top right here, if you're curious on the AUC, just to give you a quick one, the false positive rate is going to be the false positives divided by the false positive plus the true negatives. The true positive rate is going to be the x-axis on this bottom left-hand ROC curve, which I think I misspelled down there. My verb. Anyways, that true positive rate is going to be true positives over true positives plus false negatives. Again, that's the confusion matrix. There's going to be another video on that, which I've already made, which I will link as well. So how do we use all this in practice, right? How do you get into credit strategy? Everything I just covered back in these slides, this is model development. This is what I would consider quant, right? I don't know what you're going to call them. Mid office, back office. I don't know what you want to call it. We're building the actual models that are going to be used to do all the pricing. It's like quantitative research goes into this as well with methodologies, but you're model developers. You're not quant devs, you're model developers building statistical models to make decisions that the business is going to use here. Now, when you get into strategy, you start to move to what a lot of people call front office quants. I would argue front office is more or less analytics, which you'll see here. They use the models that were developed by the quants, the quant devs or the implementation teams. They're implementing those models into tools that the strategy team can use to actually execute and do the business here. Whole interesting area as well. Don't get me wrong. Interesting area, interesting jobs. It's just a little bit different skill sets. More analytics, less statistical, mathematical modeling kind of skills here. PDs, so probably the default can be used. In my example here, we're just running with it because we have all those other models we talked about earlier and a whole bunch of other ones I didn't talk about. But PD can be used on its own to measure risk, right? It is the risk of default, whatever you define that as. You can set thresholds for originations. You can set tiers for securitizations. Imagine you say, okay, I don't want to take any more risk than the probability of default of 30%, right? You have cost of capital that comes into this. So firms borrow money, even banks borrow money, right? If you're a consumer and you have deposits in a savings account or checking account or whatever, a savings account, the bank can use those funds to make loans, mortgages, auto loans, and all that. And they pay you a really, really tiny itty bitty rate. So their cost of funds is small. They don't have to mark their interest rates up very much and they can make a profit. Now, when you have smaller firms like, community banks or you have, other financial institutions, for example, they might have to go borrow that money from a bank. They might be paying 5, 10, 15% for their capital, and then they have to mark that up above and beyond to be able to make a profit. Now, they're getting squeezed on the other side of the loans. Let's say you have a 30%, charge-off rate, which doesn't transfer to dollars, but bear with me. Let's say you lose 30% there right off the top. Every loan you make, you're losing 30%. You have to calculate your profit margins. I've been at firms that have had like a 2.5 to 3% profit margin. So if you miss that loss calculation, you're going to lose money. Your cost of funds is typically pretty fixed, but often it can be a floating rate. So it can be like, LIBOR plus whatever. I guess it's now a different rate, but whatever the market rate is, the LIBOR plus X, it's going to be on that rate spectrum there. It's going to be a floating rate. You have to manage that risk, and you do that by doing models. You might have rate models to figure out what LIBOR is going to be. You might have, supply and demand curves and figure out market share, for example. You might just say you don't need a model for that. We're going to use data that we actually have internally. You're going to use that, and the strategy team, the front office here, is going to do that analytical work and figure out where we should be. Most often they're using these models along with a bunch of other data to come up with strategies for this. They might set different thresholds. They might have pricing grids, which, anyone in a big bank will know. They have these massive pricing grids, and they have different conditions and different scores that go into this to figure out like who gets what rate and why. And they use that to manage and control diversification within the marketplace as well. So, right, you don't want to end up with everybody super subprime or everybody super prime. If you're trying to operate in a band, you're going to try to be capturing different parts of the market and competing with other firms. And so you might be adjusting prices in specific ranges of that score. So let's say you have your PD score. You say hard stop at 30%. Anything greater than 30, we're not going to do. We're going to compete in everything less than 30. Well, you might price out with advance rates and interest rates, for example, depending on how you price your loans out. You're going to price these out based on the competition in the marketplace. There might be a pocket where other banks don't want to touch it. Or your model's so good, you're finding a pocket that no one else is finding. Everybody else thinks it looks awful. So in their models, it's above that threshold. So in our example, above the 30%, they don't want to touch it. Like they're just rejecting all these loans. Your model might be better or it might be wrong. And you're saying this is like this is a 5% loss rate. This is going to be an amazing loan. And you can get competitive there and you might adjust your pricing to take advantage of these different pockets in the market here. But again, you have a ton of firms, as we saw earlier, all competing for these sorts of marketplaces. PD, as I mentioned, with that CECL approach, right? It can be used for regulatory reporting purposes. Another use case for just this one model here, right? We have a whole package, a slew of models that we need to run these firms, but you can get creative here in using models for different applications. Again, you can start to bake these things into profit and loss calculations. You need timing, you need cost to come into this, right? Cost does not come into the expected credit loss. I have no balances, for example, and figure all that out. Again, front office strategy, interesting things to do. Analyzing market data, analyzing your data, using the models to help guide you and give you some, razor sharp accuracy in trying to compete in these sort of competitive markets here. Also note too, there's going to be volume and losses. So thinking about this, right? You can be the world's safest bank in the world, only make super safe loans, but you're also competing with all the other banks. So you're not going to get very much volume, right? And so imagine you're making, imagine making 10% profit on $100,000. It's nothing. Now imagine you're going to make like 2% profit on, $150 million, right? Start to think about that in general here. Now, when I was at one of the banks, we, owned about 10% of the marketplace. We originated in that year $60 billion in auto loans. It's crazy to think about that. It's crazy to even think about the models that I was the validation team on validating was actually churning 60 billion in loans per year. Again, there's a lot of teams though. So I'm talking a lot of teams, a lot of people involved in this. But back to the presentation on this, right? Looking at these volume numbers we're talking about, how do you capture market share? All right, some firms will actually take a loss to capture market share and be the bigger player. And then next year they'll shift the strategy to get a little bit more profit on that. But there's all these dynamics in markets that you need to understand, even in the credit space here, right? This is not trading or anything like that. It's not investing. You still have market players. You still have similar issues and strategies. There's also market depth as well. So, you might only be able to capture X amount of the market safely, like with good practices. It's the same in the trading space here in investing. You might have a great strategy, but you can't really move because if you invest too much in that, it'll adjust the prices and then your strategy goes away here, your profit, your edge there. So interesting things to think about as well. They all apply into the credit buy side. Just not a lot of people get into these kind of things and talk about them publicly here. Also things to look at is going to be expenses and cost of capital, as I mentioned. What loss rates are securitizable? So something I don't think I'm going to cover in here. Oh, I do cover it here in a second. Securitization is where you take those assets, you sell them to some other firm, bank, hedge fund, whatnot, and you get cash back. You typically have lines of credit. You refresh your capital so you can make more loans. And then, of course, you're going to run out of cash. So you securitize those again and get more money back. And you can keep doing this over and over and over again. Again, it's financial engineering. That's what it is. We are creating risk. We are trading risk for dollars. We're pricing it out. And then we're essentially cutting up, slicing and dicing the risk and selling it to the parties that want to take on specific sets of risk here. Now let's go into another interesting piece of this. Is going to be servicing bias. How do firms actually service loans? Again, we talked about the calls, the collections and all that. If you have collectors that are very, very aggressive, people might say, screw you, I'm not paying my loan back. You're rude, you're mean, you're nasty. I'm not paying that loan back. You might have someone that calls and is very charismatic and you're like, you know what? You're right. I owe this money back. I did have a tough time. You gave me a few extensions. Let me send you a payment right now in the mail. These sorts of things impact that. All these strategies we just talked about as well impact the data you have. So if you have a strategy that targets a very specific geographic location, so like maybe you operate in like 5 states or something. Also, if you have different strategies, like we're only going to make loans in deep subprime, if you're trying to get out of deep subprime, right? You've never seen the other customers in near prime or prime. You're trying to get into those markets. You have what's called a servicing. I'm going to call it servicing bias. Servicing bias, I think, has a more specific definition, but you have a bias because your models in your data that you currently have only been in one very specific area. You've only operated one specific firm. Even changing strategies, even getting a new CEO can make it challenging because your old data is not going to be very representative of your future data here. Other things to look at again is how much does it cost to repo a vehicle, right? And getting into these strategy pieces here, opportunity costs, fraud detection as well. This impacts it, how you handle fraud, how the strategies go into the decisioning on how you manage fraud and how you use the fraud models will all impact, again, that servicing bias of those loans here in your data and your analysis. And so you're kind of creating your own data environment, and you have to be careful you don't end up in an echo chamber with it. Again, looking at this as kind of a larger process here and a little bit more of the pricing and the models and everything. Typically, loans, you go, say you want a loan, you do an application, it runs through a fraud model, it goes through origination model to see if you even meet the strategy, the spectrum that bank is or firm is looking for. Goes through pricing, so it prices out the risk of the consumer and the deal structure and everything. Again, you have PD models, ROA models all involved in this. There's actually things called origination models as well at many firms. It's a whole other thing. And then again, you book the loan and you do due diligence on this. You check. You do what's called STIPs, which are stipulations. High risk customers have STIPs, so proof of income, proof of residence. There's a bunch of other ones in there as well, but you're checking documentation, make sure it's a real person that's going to make a real payment, proof of employment, and you do that. And then those loans get made and they book those and onboard those, and then they go into a servicing. So some company services that loan, right? They collect all the payments, they do all the accounting behind the scenes, they keep track of your payments as well. If you're delinquent, they call you. If you're charged off, your vehicle gets repossessed. Those are the companies that do all the servicing. Again, a big bank will do this entire spectrum here. And then finally, as I mentioned, firms will make a bunch of loans and then they need to securitize them. Now, securitization is just taking all those loans you have and selling them into the markets to other participants that want them. I will not say who was doing it on this, but one of the banks I was at, we were in deep subprime, and one of the banks that was really prime wanted exposure and diversification to these subprime markets. They didn't want to go out and hire a bunch of quants and a bunch of servicing experts and a bunch of all these other departments to do subprime auto just to get some exposure. So securitization is a really good way in this example of how you get exposure to other sorts of spectrum of the credit. You can also get exposure to other parts of it. So imagine you're a small bank, right? Say you're, I don't know, community bank or something, and you want to get into the mortgage market, but you guys don't do mortgages because they're so large. You've only done personal loans and auto loans, for example. How do you get exposure to the mortgage market? Securitizations. Securitizations also are a pool of assets, so you reduce the risk there as well. Again, depending on which tranche you buy. But you can get diversification through securitization. So it's a very beneficial process from the banks or the firms doing the securitization and selling those assets off. It is a good diversification tool and exposure process. And like hedge funds buy a lot of this stuff up as well to get these exposures for them. So they're diversifying on their end as well. So it's a win-win as long as it's done properly, as long as the due diligence is done during the securitization. I know there's been a bad taste in everyone's mouth with, 2007, 2008 financial crisis with mortgage-backed securities going under. But there's actually like a good use case for this. It's not like people are just gambling to gamble here. And that's a whole other process in the whole crisis as well. Towards the end of all this, right, we have model monitoring. So somebody actually has to model these monitors and check them. There are a plethora of ways of doing this. I'm not going to go into it in this video, but there are teams that do this at the end too that monitor everything. I typically use what's called PSI, so Population Stability Index. You can see how the distributions are shifting and changing over time. As we talked about in credit, you have zeros and ones, right? And so it's harder to manage those. Doing a distribution is much easier to see how these things kind of shift and move over time. But they give you an understanding of when your model is starting to fail, ramp up your quants, get developing the next model, have it ready, and you can switch over to that new model, because economic shifts often make models fail because consumer preferences change, cost of manufacturing change, a lot of things that are out of our control will change. Maybe other firms go bankrupt, maybe it gets more competitive, less competitive. These will all impact this. It'll impact your modeling as well. So you have to rebuild models over time, but you got to monitor them so you know how to do it before they go bad, right? You don't wait for a model to blow up and then be in a crisis here. So just quick kind of conclusion here, right? Job markets, credit markets are interesting. They're large, they're huge. There's a lot of machine learning in the space as well because we have so much data, right? It's just a different kind of perspective here. It's a different market. I would highly recommend a lot of students out there consider going into these markets and these spaces. They're interesting. The jobs are stable. They might not pay as much in the long run, but you have good career growth. You have interesting work to do. And they're fun to be in. And there's a lot of different spaces in here. So we talked about the strategy piece. We talked about model development piece. I kind of briefly touched on the other teams that are involved in processing on these. There's a lot of business people involved as well. Banks are a lot more interesting than people think. I know. I hear everyone say, oh, these big old boring banks. And I remember in grad school, I was like, please don't end up in credit. And I ended up in credit. And I love it. It's just a really exciting and interesting space to be in here. But there's a lot of jobs here too that people don't see on the quant side, on the risk management side of this, which is just building all these models. Again, quant topics, things to look at, right? Bureau data is different. It's unique. Cleaning it, handling really large data sets. We ran out data sets that were like 4 terabytes in size, which is enormous. And you have to sample down because you have too much data. And then there's getting business buy-in and working with all the departments. It can be frustrating. I know. But it's also going to be rewarding. You can build interesting relationships with that. Again, modeling types, logistic regression, XGBoost. I've done ARIMA, Cerimax, GARCH, modeling like volatilities, movements, and things, right? Any model you have seen in grad school, in stats class, and econometrics, you can use in banking somewhere, somehow here. I mean, banks even touch the market risk side of this as well. I didn't mention reject inference in the presentation, but it is something interesting. If you're interested, go look out and see what that is. It's an interesting thing to overcome biases within that competition space and dealing with data that you've never seen. Again, there's all kinds of interesting metrics and strategies all baked into this as well. Cost, markets, volume, and all that. Just like the buy side, the investing side of this, there's a lot to do in this market here. So anyways, thank you guys for listening. Thank you for watching. Yes, this presentation I did with Agora over at Illinois Tech, as I mentioned here. So big shout out and thank you to them for employing me and supporting me in these sorts of presentations at the conferences. So if you found this interesting, don't forget to like, share, and subscribe. And as always, until next time.